Hello and welcome to episode 3 of Budget Decoded by HDFC Securities. I am Preksha Shah, and as we continue decoding the Union Budget 25-26, today's discussion is all about taxes, what's changing, what's staying the same, and how it all impacts individuals and businesses. To help us break it down, we have a very special guest, Mr. Laxmikant Lokhande, Deputy Vice President of Investment Products at HDFC Securities. With his deep expertise, we'll navigate the key tax proposals, potential tax saving opportunities, and what investors should be watching out for. Mr. Lokhande, great to have you with us today.
Thanks so much, Praksha. My pleasure.
Okay, so let's address the main headline of the upcoming budget. Personal taxes always grabs the attention ahead of budget. So the big
Yeah.
question arises, will the government tweak income tax rate this time?
Well, on the personal tax front, we do believe that there could be some relief for individuals, and that would be typically for individuals with annual income up to say 10 to 15 lakhs. And there is a primary reason for that. What we have recently seen is that India's GDP growth has moderated. So in order to boost consumption, which counts for 50 to 60% of our GDP, we believe that government will provide some tax sops to allow individuals to have more disposable income in their hand so that they can spend more and drive the economic growth. Now, the tax relief can come in various forms. So it could be either in the form of government can raise the deduction limit, or there could be, reduction in the tax rate for a particular slab rate, or the overall increase in the slab rate can be increased. So in the either form, we believe that, there would be some form of tax swaps which will be announced by the government, especially to help the economy and provide more disposable income to the individuals.
Okay, great, great. And if there's this relief, will it come through the new tax regime or old one? And also, could we finally see the finance minister doing away with the old regime altogether?
Yeah, so that's an interesting one because this new tax regime was introduced in FY21 budget by the government, and the primary aim was to reduce the tax compliance and simplify the existing tax structure. With that, we have seen in the recent years that most of the important changes in the taxation have been introduced through the new regime and to make it more attractive for adoption by the individuals. So we believe that any tax relief, if at all it comes, that will be coming through the new tax regime, and it is likely that old tax regime will be phased out over a period. And on your second part, will there will be merger or will finance minister do away with the old regime at all? Over the period, we have seen that old regime has not got any major changes or many major incentive. So from that perspective, we believe that the old tax regime will eventually be phased out over a period of time, with more and more attractions and more tax ops being introduced through new tax regime.
Okay, got it, great. And what about professionals and gig workers? Any specific incentives or tax breaks that could be on the table for them?
So see, apart from whatever tax offs being announced for individuals, that would apply to professionals as well in the sense. However, professions typically follow a presumptive taxation. Now, what happens in presumptive taxation is that, a government assumes a certain percentage of your turnover or gross receipts as your taxable income, irrespective of the expenses incurred. Now here government has defined certain limits. So for example, for professionals, that limit is 75 lakhs annual income. Now any increase in limit which happens beyond this particular limit, that will benefit the professionals. Apart from that, another interesting thing which needs to be taken into mind with respect to professionals and gig workers is that they typically struggle with tax filing, and the tax compliance becomes difficult. So in that sense, if government announces any ease of filing norms or compliance measures for these professionals and gig workers, that will also eventually benefit the professionals in terms of their tax compliance, tax filing, and ease of overall taxation norms.
Okay, okay, so great. Coming to personal finance, so taxation on various asset classes have seen quite a few changes in the recent years.
Yeah.
So, like from an investor's perspective, what can investors expect from this budget, and are there any expected changes to the taxation of mutual funds and direct equity investments?
So yeah, as you rightly pointed out, in the last, especially in the last budget and the previous year, we have seen many tax changes coming into picture, mostly for the various asset classes, and some of them include last year we saw increase in long-term capital gains and short-term capital gains rate for direct equity and mutual funds, wherein your LTCG was increased from 10% to 12.5%, and STCG was increased from 15% to 20%. There was a reduction in holding period for the classification of LTCG and STCG across asset classes, apart from obviously the non-equity, as in apart from equity instruments. So there was a reduction in holding period from 36 months to 24 months for asset classes like fixed income instruments, gold, real estate, and other non-equity instruments. Importantly, there was a change in removal of indexation benefit. Now, indexation benefit basically allows your cost of investment to be adjusted against inflation. Now, that was another big change, with the removal of the indexation benefit. And prior to this particular budget, last year's budget, there was a change in the taxation of debt mutual funds, wherein irrespective of the holding period, the taxation was marginal taxation, that is as per the tax bracket of individual, and that was an important change. Along with that, the indexation benefit was removed last year. So these were some of the key changes in taxation, and we believe that government may further rationalize the taxation rates and holding period norms to simplify the taxation compliance and ITR filing. If you also look at the commentary from the finance minister over last 2 3 years, is that the focus has been more on the simplification of the taxation rules. So there could be a few more measures wherein the holding period or the LTCG, STCG norms across the asset classes could be brought in at par along with the other products as well. So right now what happens is, so for example, for equity, the holding period is 1 year for classification of LTCG and STCG, whereas for other asset classes, it is 24 months. So the ask from the investors community in the market is that it is to bring the holding period at par, and also the rationalize the taxation such that the taxation remains at par for all the asset classes. One, for the ease of tax filing, and secondly, one particular asset class should not have the disadvantage when it comes to investment, because taxation becomes an important perspective when it comes to investments. And on your second question, any specific changes to the taxation of mutual funds and direct equity investments? We just saw, large changes in the direct equity taxation. So probably this year could be a status quo. However, with respect to taxation of mutual funds, hybrid mutual funds is one category wherein the taxation lies somewhere between equity and fixed income. So there could be some rationalization on that aspect.
Got it, sir. And so, could we see any further changes specifically in how debt funds and fixed income securities are taxed?
So as I just explained, last 2 years have seen, sweeping changes to the debt mutual fund taxation. Now, one change was the removal of the holding period, wherein earlier there was a 3 year of LTCG and less than 3 years holding period. The STCG used to apply. Now, any investments done after 1st April 2024 basically has marginal taxation, and basically then there is no concept of holding period here. Any investment, so sorry, the any investment which is done after 31st March 2023, so last 2 years whatever investments have been done, that classify for marginal taxation irrespective of holding period. Secondly, in last budget there was a removal of indexation benefit. So now the mutual fund industry has been asking for at least the restoration of the indexation benefit in debt funds. And as I previously explained, indexation basically allows you to adjust your investment cost against inflation, which results in your lower tax liability. So that is one important change which may come in from the mutual fund perspective, if finance minister listens to the industry demand.
Got it, got it.
Yeah.
Great, Mr. Lokhande. Thank you so much for your valuable insights. This has been incredibly informative discussion. And with that, we wrap this special series of Budget Decoded by HDFC Securities. We hope these episodes have helped our investors navigate the key takeaways from Union Budget 25-26 and make more informed investment decisions. Thank you for tuning in, and as always, happy investing.
Thank you for having me.
Thank you,
Yeah,
sir.
yeah,
Thank you
yeah,
so much.
yeah.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.